folks, how you doing? Let's continue our journey into the world of derivatives. In the last session, we briefly touched upon four major types of derivatives. And among them, we said options are the most popular, especially in the stock market today. But what exactly is an option? And what does it really mean when someone says call option or put option? Let me break it down for you in the simplest way. Think of it like this. You go to a mobile store. The latest iPhone is selling at 80,000 rupees today. But you don't want to buy it right now. You say to the shopkeeper, "Boss, take 1,000 rupees from me right now and give me the right to buy this iPhone at 80,000 rupees anytime in the next 1 month. If I don't buy, keep the 1,000 rupees. Now the shopkeeper agrees. That 1,000 rupees is not the price of the iPhone. It's just a kind of booking fee. But more importantly, it gives you a right, not an obligation. Now pause for a second. You didn't promise to buy the iPhone. You only bought the right to buy. That's the key idea of an option. So, this kind of deal, where you pay a small fee in advance to keep your right, that's what we call an option contract in the stock market. Now, let's bring this into market language. That iPhone deal was like a call option. Why? Because you paid money to get the right to buy something at a fixed price later. In market terms, if you buy a call option on Reliance at 1,400 rupees, you're basically saying, I want the right to buy Reliance shares at 1,400 rupees anytime before expiry. And I'll pay a small fee called premium for this right. Simple. Now the opposite of this is a put option. In this case, you're buying the right to sell something at a fixed price. Suppose you hold 10 grams of gold worth 1 lakh rupee today. You're worried that the price might fall in the next month. So instead of taking the risk, you decide to buy a put option, a contract that gives you the right to sell your gold at 1 lakh rupees anytime in the next 30 days, no matter how much the market price drops. To get this right, you pay a premium of 2,000 rupees. Now imagine gold falls to 97,000 rupees. You can still sell at 1 lakh rupees because you hold the right to sell by buying the put option at 1 lakh strike. That means you avoid a 3,000 rupee loss. You're protected. Your only cost was the 2,000 rupee premium. You're effectively ensuring the value of your gold. So who's on the other side of this deal? That is the person who sold you the option, or the seller is taking the opposite view. They believe gold won't fall below 1 lakh rupees. If they're right, and gold stays above that level, you won't use the option, and they keep the 2,000 rupees as profit. But if gold crashes, they must buy from you at 1 lakh rupees, even if the current price is lower. That's the risk of seller. In reality, such contracts are not made between individuals over a handshake. They are created and traded on stock exchanges like the NSE in a standardized, regulated, and anonymous format. You don't meet anyone personally. You simply place your order through your broker, and the system automatically matches you with a counterparty on the other side. This is exactly how it works in the real world, whether you're trading options on gold, stocks like Reliance, or indices like Nifty. So, let's connect the dots now. A call option gives you the right to buy something later at a fixed price. A put option gives you the right to sell something later at a fixed price. And in both cases, you pay a small fee called a premium. But remember, options are a right, not a duty. If the market goes in your favor, you may exercise the option. If it doesn't, you can just let it expire. The maximum loss is only the premium you paid. Interesting, right? One more thing before we close. In every option contract, there's always a buyer and a seller. The buyer pays the premium and gets the right. But the seller, well, he gets the premium upfront, but he also takes on the risk. In our iPhone example, if prices shoot up to 95,000 rupees and you buy at 80,000 rupees because of the deal, who's losing money? The shopkeeper. That's the option seller. So, understanding both roles, buyer and seller, is very important. And trust me, for option sellers, the game is very different. We'll talk about that in the upcoming lessons. For now, Just keep this in your mind. Call option is equal to right to buy, whereas put option is equal to right to sell. And the premium is the small price you pay to get that right. Now, take a pause. Think about it. And when you're ready, we'll move forward into the key terms like strike price, expiry, premium, and lot size, the building blocks of any option contract. See you there.